Hello and welcome back. In this class, we are going to discuss about income from house property. You all know that we have 5 heads of income under the Income Tax Act. We have income from salary, income from house property, income from business or profession, income from capital gains, and income from other sources. Income from house property is the second heads of income. So it is the income that is derived from the house property. The income from houses, buildings, bungalows, godowns, etc. is to be computed and assessed to tax under the head income from house property. The income under the head is not based upon the actual income for the property, but upon the notional income or the annual value of the building. So house property income is equal to annual value of the building minus the deductions specified under section 24. For income to be taxed as an income from house property, the following important points must be carefully noted. Income from building or land situated in India. The annual value under section 23, the annual value is equal to the annual rental value. The assessee should be the owner of the property or deemed to be the owner of the property. An individual who transfers his house property to his or her spouse or transfers to a minor child not being a marrying daughter. A member of a cooperative society to whom a building allotted or leased under a house building scheme of the society. A person who is allowed to take or retain the possession of building and the holder of an impartable asset. The person who acquires any rights. But the fourth point that you have to keep in mind is it is not used for the purpose of assessee's business or profession. Important points that you have to note under this fourth point is house property held as stock in trade, house property partner used by firm, house property is held in the name of business but actually used for business. Dispute about ownership, the person who receives the rent shall be liable to pay the tax. House property situated in a foreign country, only resident but ordinary resident is taxable. And in case the house property is situated in a foreign country, and if the assessee is a resident but not ordinary resident or a non-resident, it is exempted, but income received in India and payable in India is taxable for all cases. The cases when rental income from business is not treated as a house property income. Letting out of house property for smooth conduct of assessee's business or profession. If a person lets out any property for smooth conduct of a business or profession, the rental income from such house property shall not be treated as house property income. Rather, it shall be treated as income under the head business or profession. Example, quarters let out to employees' own business or profession, or building let out to a bank, post office, or a police station or excise department and police department, and etc. Now let us analyze the different terms used in determination of income from house property. Section 23, income from house property is taxable on the basis of the notional value. Even if the property is not let out during the year or let out only for a part or a year, notional rent receivable is taxable as its annual value. Annual value of the house property is based on the following factors, and the same are defined. Municipal value. It is a valuation by the municipal authorities for charging taxes on house property. Next, fair rent. It is the rent a similar property in the same or similar locality that can fetch you. The next term which is commonly used is the standard rent. It is fixed under the Rent Control Act, where the rent is higher than the standard rent cannot be expected by the owner. Actual rent, it is actual rent received or receivable by the owner of the renting out the property. Expected rent, higher value between municipal value and fair rent subjected to a maximum of standard rent is expected rent. There can be three cases for the gross annual value of a let out property to be calculated. So this table shows you the three cases where we can compute the income from house property. One is let out property LOP, DLOP, that is deemed to be let out property, and SOP, that is self-occupied property. So the way of how do we calculate is gross annual value minus local taxes or municipal taxes. That gives us net annual value. From the net annual value, we have specific deductions under section 24, that is 30% of NAV and interest on loan. And the remaining amount becomes the taxable income. But important point to be noted is, in case of a self-occupied property, the NAV is always zero. Now let us understand how do we compute the gross annual value. What is gross annual value? Gross annual value is the first item that we take in the computation of income from house property. And gross annual value is going to be calculated first. So we have three important steps in the computation of gross annual value. First, we have to consider municipal rental value or fair rental value. Whichever is higher is the value to be considered in the second step, and that is compared with the standard rent. And in the second step, we compare the higher value from the first step and the standard rent, and whichever is lesser is going to be the termed as expected rental value. And in the third step, we take the expected rental value and the actual rental value. On comparing these two, whichever is higher is our gross annual value. So this is how we calculate the gross annual value. In the coming class, we will start doing the problems on computation of gross annual value. Thank you. Have a nice day.